Hi, I'm Leslie DeLuca, broker, owner of DeLuca Real Estate. As a real estate professional, my colleagues and I are always looking for ways to make the home buying and selling experience pleasant for you. We also work with the powers that be to make sure that the tax laws and the value of home ownership and investment stays positive. I have been realizing that all of the tax changes that were made in December, there's still some confusion. So today, I want to explain the big three and finally put to rest the fears that a lot of you have about the changes. I want you to understand that buying a home and home ownership is still a great idea. So, the first thing I'm finding that people are really confused about is the mortgage interest deduction. Now, what was proposed was to limit the mortgage interest deduction to $500,000 and eliminate second homes. That's not what happened. Now, put this in mind, bear in mind that we were never able to deduct all of our mortgage interest. We were only able to deduct up to $1 million. Now with the new, this is what we have. Mortgage interest deduction is, under the final bill, you can deduct up to $750,000 in your mortgage. So the amount was reduced by $250,000. This also includes home equity lines and second mortgages. Good news, right? So don't think you cannot deduct your mortgage interest anymore. You can, up to $750,000. So if you have a mortgage up to $750,000, you're okay. Anything over that, you cannot deduct. That is the first thing people are worried about. The other thing that people are concerned about are the state and local taxes, or SALT. Now, under the proposed bill, we would have completely had the state and local taxes eliminated. And the property taxes would have been able to be deducted up to $10,000. While what we ended up with isn't as beneficial as what we had, here's what it is. State and local taxes. Okay, they wanted to eliminate it. The final bill allows deduction up to $10,000 itemized for the total state and local property taxes and income or sales taxes. This $10,000 limit applies for both single and married filers and is not indexed for inflation. The final bill also specifically precludes the deduction of 2018 state and local income taxes prepaid in 2017. So, not bad. So, $10,000 of your property tax bill is deductible, or state and local taxes, or whatever you have. So, does that mean that home ownership is a good idea? So, the exclusion of gain on the sale of a personal residence. The proposed bill would have made it so that you had to live in the house for 2 out of the last 8 years. Didn't happen. It stayed with what we have. You must live in the house for 2 out of the last 5 years. So, if you have a rental property and you want to sell it, you have to move into it for 2 years. And then you can call it a principal residence. That's it. That's what happened. Nothing changed. They retained what we had. So, if you want PDFs of any of this, I have them uploaded to Monterey Home Buyers Support Group on Facebook. So if you want to join the Monterey Peninsula Home Buyers Support Group on Facebook, there's a link on the blog that will tell you how to do that. All the files are uploaded there, and that's a really great place where you can find lots of information about home buying. And remember that I am not a tax professional. All of this was given to you just for reference. They're just for illustrative purposes. For your own personal tax situation, please contact your tax professional. Thank you for watching. As always, we would like to make sure that you know that we are always here to answer your real estate questions 24/7. You can click on our videos or go to the Monterey Peninsula Home Buyers Support Group and get all kinds of valuable information. Until we see you again, goodbye.